in real estate, we can scale, and same with business. You can't really do that as a medical professional. One day you wake up and you realize you're wearing the golden handcuffs and you're trading your time for money. And it's not just that you're trading time for money. You're stuck in the hospital. You're in the OR. You're in the clinic. And if you don't show up, nothing happens.
Hi, I'm Tim Bratz, and every week I sit down with the top influential entrepreneurs in the country to discuss how to leave a true legacy in all things happiness, health, wealth, and wisdom. This is the Legacy Podcast.
Tim Bratz here. Welcome to the Legacy Podcast. Today I have my good buddy, Tyson Cobb. Tyson comes from the medical field and was very, very successful in orthopedics and in his medical industry, and took that and realized, at the end of the day, he's got to trade his time. Although it's high-paying time, he's got to trade that time for money. And so what does it look like if you're a white-collar professional and transitioning into some different investments and figuring out how do you take that high income, deploy it into investments so that way you can retire early, buy back a little bit more time. And Tyson's made it a business. He's realized this is a lot of white-collar professionals have run into this hurdle and they're banging their head against the wall of like, how do I really start building that other long-term wealth with all the money that I'm making in order to then have a little bit more time, be able to go travel. And really, there's nobody who I think has a better lifestyle than you, Tyson. So I'm excited to dive into all that stuff, man. You've really, I think, figured it out. I've had you sit on our panels at the Legacy Family events and talk about lifestyle design. And so I want to dive into all that stuff. I think talking about white-collar professionals today, how to take that income, invest it, right, into their own type things, maybe even turn it into a business like you have, because you've been able to go and raise a lot of money from other white-collar professionals for different deals that you're doing in both real estate and business. I want to dive into that. And then also the lifestyle design side of things, I think are all really, really good topics to dive into. So, brother, appreciate you being here, man.
Hey, it's good to be here. Thanks for the invitation.
Yeah, absolutely. So let's talk a little bit about your past, right? Maybe you can give everybody a high-level overview on your history in the medical field and how that has kind of transitioned into you investing in real estate.
Yeah, so I've been an orthopedic surgeon practicing here in Iowa since 2000. I was with the same group for about 20 years. And in 2019, I left my group. I went off call, dropped back to 1 day a week. And I still smile every time I say that. Still working 1 day a week in orthopedics. And I enjoy orthopedics, but when you're young, drinking out of a fire hose, taking call, it's a lot of fun. And then after a while, it kind of starts to become a grind. And one day you wake up and you realize you're wearing the golden handcuffs and you're trading your time for money. And it's not just that you're trading time for money. You're stuck in the hospital. You're in the OR. You're in the clinic. And if you don't show up, nothing happens.
Mm-hmm.
So, as you know, in real estate, we can scale, and same with business. You can't really do that as a medical professional. So making that move was, it was a little terrifying, to be honest with you, because,
Mm-hmm.
leaving a group of 20 years and a career that you've poured yourself into, and then, moving into the real estate world where, suddenly you're not at the top of the heap anymore, right? You're not the guy that people come to ask questions about, help me with this problem. You're not the guy, I was the guy that traveled all over the world teaching other people how to do high-tech, minimally invasive procedures, and then suddenly I'm at the bottom of the list. I'm joining your group and taking commercial empire and trying to learn a new language in real estate.
Mm-hmm.
And so it's very, it's a humbling experience, but at the same time, I love a challenge and I love learning new things. And this certainly presented, both of those, because I didn't know anything about it. I don't come from a family background of real estate at all. My dad was a farmer and rancher, so it was all new to me, with the exception I had invested in farm and ranch ground virtually all my life.
At what point would you say that you felt confident that you had enough because I'm sure you had something going on in real estate in 2019, right? I think we met in 2018, 2019 originally.
Yeah.
And I think at another mastermind. And so at you had something going on. Were you already investing in some different things? Like you had already dipped your toe in the water a little bit?
Yeah, just a little
What
bit.
gave you that confidence to then move and make that decision?
Oh boy, I just tell people you just have to get comfortable being uncomfortable. And that's growth, right? I mean, if you want to maximize your growth, whether it be personal growth, relationship growth, business growth, it's all about just getting comfortable being uncomfortable and moving into that next area and be willing to take some risk and be vulnerable. Um, so yeah, I mean, I think that's
Yeah.
what allows
Did
a
you have
great.
anything going on in real estate before you jumped in all in on real estate or before you scaled back your calendar?
I started out with land and did pretty well with farm ground here in the Midwest.
Mm.
It does well if you, it's like anything else, if you buy it right, and you can value add on the land as well if you know what you're doing. Moved into triple net. That created. I just jumped out and bought a gas station and convenience store as my first purchase. Had a friend who was doing some stuff and a colleague that worked with. JV'd with him on the next one, bought another one after that, and then I went through your commercial empire several times, and then started investing in multifamily. Started out in the LP space, and it's a great way to kind of get to know teams and watch people operate, and once you invest as a limited partner, you're getting the updates. You kind of watch what happens and see things unfold and see how the business plan plays out or doesn't, and how does the team deal with problems and overcome issues. And it just allows you to get comfortable in the space and get comfortable with different teams and kind of figure out, who you might want to do more investing with and who not, and so forth. But yeah, it's just exposure and staying in it.
Yeah, you've done a great job, obviously, investing your own capital into different projects, figuring out who those operators are, who you want to do more business with. Um, when did you see it as an opportunity to raise money, right? I remember when I first got involved or when I started talking about what I was doing in real estate, people started knocking on my door saying, hey, man, can I buy deals from you? Can I sell deals to you? Can I joint venture with you? Can I um, uh, invest in your deals, or can I pay you to coach me, right? And so you start hearing that enough, and all of a sudden you're like, all right, well, maybe there's an opportunity here to start something new. Is that kind of what happened with you? You were out there investing in all these different real estate things, and then other white collar professionals said, Tyson, man, bring me along. Tell me about what you're doing. Like, can I invest aside, like aside you in these different deals? What did that look like? What are those conversations? And how did you realize you can now start pooling capital and then writing bigger checks?
Yeah, so I love the saying, "Man plans and God laughs," right?
Mm-hmm.
And so I mean, I was going down the path of acquisitions, working with Nick, as you know, putting in tons of offers, and that was back when there were so many buyers at the table. It was just almost impossible to find a good deal, especially if it was
Yeah.
already on the market. And I had invested with Gabe, who was in your mastermind, and that's where I met him as a limited partner. And we found a property here a mile from the house that didn't fit your buy box. So I reached out to Gabe and said, "Hey, would you be interested in helping me syndicate this deal?" And he said, "Sure." So we worked on that for about 6 weeks, and it fell through, and we walked away from it. It's a good thing we did, but that's another story. After the fact, he said, I can tell you really want to do the general partner thing. He said, we could use some help on this one that you're already investing in San Antonio. Would you be interested in joining the GP team?" And I said, "Sure, I'd be glad to. It'd be great. What would you want me to do?" And he said, "Well, one thing we're still working on is we're still raising some CapEx for some money for CapEx, and can you raise capital?" And I'm like, "Gosh, Gabe, I never thought about raising capital. I said, I don't know, give me a little time here. So I just, called some people that I knew, and in a week I was done. And
And when you say people that you knew, where are these folks coming from? Because I think what I've found and what I've seen in the real estate space over the course of the past 5 years, money was very easy to come by. right? And so a lot of these deals got purchased. And when things got hairy, interest rates go up, insurance costs started increasing. Um, just operationally, management companies aren't doing what they're supposed to be doing. Energy costs are going up, labor costs are more expensive, and people need to inject money. I'm finding a lot of the folks who, you know, maybe raised money or maybe raised it from a single group, never really built the muscle to go out and raise money in $100,000 increments. And they're really in a tight spot and have had to hand back a lot of properties or sell those properties because they couldn't gain access to more capital. Um, and I think that's one of those skill sets that is absolutely critical. I think the most important skill set that you could learn in business probably is raising money, because if you can raise money, you have a huge uh, demand for your services in any industry, in businesses, in real estate, in nonprofits, doesn't matter. You are always highly, highly valuable. And so, um, being able to raise money and be able to go into somebody's deal and help them raise more capital for that project, I would think puts you in a really, really good position. So where were you finding these people from who were you're raising capital from? These are people already in your network of doctors or outside of that?
Yeah, so these were close friends, hunting buddies, people. One of the guys I reached out to, I had worked with on some medical patents. I mean, people that I'd known for a long time and knew well, who, I knew had the capital to deploy. And and then it just spread from there. So, we started out as a handful of orthopedic surgeons investing together. And over time, it just spreads. People are looking for good investment opportunities.
Mm-hmm.
And
Always.
so you just have that organic growth over time. And it helped that I was very involved in academics as an orthopedic surgeon. So I taught labs all over the country and wrote chapters for textbooks and published over 50 research articles and peer reviewed journals, and had given, probably 1,000 lectures or taught labs, and so I was in front of people all the time as an orthopedic
Mm-hmm.
surgeon for like 20 years, and so that created a network of people that I had exposure to, and that type of exposure where you kind of already have some level of know and trust makes it kind of easy to go to the next level. So, people ask me about, who do you go to? Who do you know? Are you
Mm-hmm.
an avid golfer and you're, a member of the country club, then, go to those people because they see you every week out there. So, I mean, I think you want to go to your people, whoever that is. It's different for everybody.
I will say I find you hang out in doing wealthy kind of things where wealthy people hang out, right? You hunt, you fish, you are a big wine aficionado, right? Like you travel a lot, and you're hanging out also in a lot of these mastermind groups. Like
Right.
you're in a different mastermind at a different event twice a month, three times a month, right?
Yeah.
You're always
You
at
know,
these
a
things
lot.
where people know you, and you're not a I think somebody might hear that and think, oh, well, Tyson must jump around a lot or what. No, it's like you've been a member of many of these masterminds for many years. You've been a member of Legacy for, I don't know, 4 years, 5 years now. And so you're consistent, right? You're
Right.
consistently showing up. You're consistently showing people you're here, not for the transaction, but for the real long-term relationship that comes with it. And I think there's a lot of trust and a lot of confidence, even when things go sideways in markets or whatever that looks like. You're still standing strong, and that makes you separate from the masses and really stand out when everybody else goes running for the hills. You're still there, you're still doing deals, you're still transacting, you're still talking to your investors about doing deals when a lot of people are on the sidelines and pressing pause. And so I think that you've done a lot of things, whether it was intentional or unintentional or kind of combination, that were the right things, because you're a guy of good character. Like all this stuff of just how you operate as an individual has really set you apart in the capital raising side of things too, from what I've seen.
Yeah. Well, I mean, you say it all the time, and it's so true. If you bring value, it's going to happen. So what I just described when I first started is very different than what we have now. So I've started Timberview Capital. My son Colton has helped me with that because I'm an old school guy, so CRM and all that stuff all over the top of my head,
Hmm.
But he's good at that. He's good at hiring people. We've had to hire a ton of people because we've grown so much. And we do webinars that he's talked me into doing as well. Otherwise, I probably never would have pulled the trigger on that. And that's one of the ways we bring value. We do a ton of tax strategies now, and we have fantastic tax strategists and CPAs that kind of have their own little niche that they've developed. We're doing things like discounted Roth rollovers, where you start with a self-directed account, put it into an appropriately selected syndication. You're able to get a valuation at a lower level, so it's a little like a depreciation. It's a paper loss, but not a true loss. And then you roll it into a Roth. And then once you get that in, when you play that video forward and that snowballs over time, that money's tax free. So
Hmm.
that one, as you know, is growing tax free instead of tax deferred. And all these different levers can save an incredible amount of money every year on taxes, and it speeds your net worth growth substantially. And
Hmm.
so that's one of the things that we do from a value standpoint, in addition to a variety of different uncorrelated asset classes, is just having a ton of tax strategies that we can tell people about and educate. And of course, as you know, everybody's situation is different and it changes every year, right? So what's really good for one investor this year uh, may not be the right thing for them next year. So we've got a bunch of different strategies that help fit that. And I'm not a CPA or tax strategist or attorney, but I've studied it extensively because it's important to me and it's important to our investors. So it's been something that we've pursued pretty aggressively over the years.
Well, I think I mean, we were talking offline about that is eh, when you're out there raising capital, you need to kind of almost take orders, right? Like you're out there seeing what the investor needs and then reverse engineering an opportunity that meets their needs. And really what I found is it falls into one of three categories. One is they want predictable cash flow. They don't care about equity growth, about upside, as long as there's no downside. If they have predictable cash flow, even if it's a nominal amount that beats the markets or beats money markets, that is something that's highly desirable for a lot of people. There's other people who like the equity growth, right? And they're willing to be a little bit more risky if there's bigger upside and bigger returns potentially. But they need to realize there's also some downside as well. And then there's the tax strategy, right? People who make a ton of money doing what they're already doing. How do they keep more money? They realize Uncle Sam is their biggest expense. And so if they could figure out how to keep more money or how to defer that tax liability, or pay the taxes now and then let it grow tax free. And that is very, very important for a lot of people because they already have the income, they already have the cash flow, they already have the equity growth or whatever. Now they're just trying to keep more. And I think that's one of those things that's overlooked. And people, it's not the sexy stuff like high equity growth or return on investment. It's actually usually third conversation that you get into. But what I found is it's almost maybe potentially the biggest needle mover in what your quality of life can look like, right? If you make $300,000 a year and you pay taxes on it, and a third of that's going to the government versus $300,000, and that's $100,000, right? You're only keeping 200K versus you make $300,000 a year and you can offset it with depreciation or some sort of tax advantages, and you're keeping $300,000 a year. You just gave yourself a 50% cash on cash return on investment on what you make on an annual basis. Like, where else are you going to get those kinds of returns? And so I think it's one of the earlier conversations that I have with a lot of our investors is making sure that they understand what that tax liability looks like and what it could look like if they had real estate professional status, if their spouse had real estate professional status, if they, depending on where their income's coming from, if they have depreciation, if they could offset it somehow, their earned income with different strategies. And so I think it's a big deal. And I think that's where you've done a great job of shining is you're not necessarily selling the investment. You're offering an investment and educating people along the way. And that makes a big difference. Selling somebody something, nobody wants to be sold anything, but educating somebody on here's things that you could do. And by the way, I have an opportunity that matches exactly what you need, it's a totally different offering versus a sale, right?
Yeah, so it's a great point. And, it's not uncommon. Investors are like, oh, you got a lot of different offerings here. Which one's the best? And the answer is
Mm-hmm.
it depends. I mean, what's important to you? And the three things you pointed out are definitely the top three. There's a fourth one that I've learned more recently, and the bigger players are all about capital preservation.
Yeah.
So, I mean, once you get to a certain level, like family office or people that have done well enough that maybe they're getting closer to retirement, they're not so concerned about equity growth, and in some cases, they're not even concerned about cash flow because they have plenty. But they're almost always concerned about the depreciation, and they're very concerned about capital preservation. So,
Mm-hmm.
a lot of those players will take a lower return for a lower risk. And so, when I'm talking to a new investor and it's not uncommon, their first question is, which one's the best? Well, what's your risk tolerance? Do you need cash flow now? This is a long-term investment. So second question is, okay, you don't need cash flow now. What do you think your needs are going to be in 3 to 5 years? Because this is a long-term play. It's set up on a 5-year pro forma, but that's no guarantee that you're going to actually get your money back in 5 years. So what if
Mm-hmm.
this thing gets kicked out to 6 or 7 years? Is that something that you're going to be able to tolerate, looking at your work schedule and timeline moving forward? So those are all super important questions that frequently these guys have never even thought about. Their financial advisor who helps them in the stock market has never really had this discussion with them.
Mm-hmm.
And so they don't think about these things. They don't think about capital preservation. They don't think about the depreciation. They don't think about the tax consequences. They're not savvy to the equity growth type investments versus the high cash flows with stabilized properties that are going to be cash flowing from literally the first month. And
Mm-hmm.
so once you've had all those discussions, then you can kind of figure out what lane these people need to go down, but they don't even realize that because nobody's had that discussion with them.
I think that's an important uh, thing to note is what are we competing with? What we're competing with is like the only thing that people know about is what they see on TV or what they were raised about, right? Or to learn about, right? It's things like the stock market and return on investment interest rates. Like those are the only two things that we're competing with. So when you come in and you educate that there's equity growth potentially in a different investment, or there's higher return on investment, and you start educating on all the tax advantages and the stability of or the safety of the investment. These are all things, like you said, man, people aren't even talking about it. They're not even thinking about it. They didn't even know that those should be factors. And I think there's a lot of credibility that comes to you on the education side of things because their financial advisor, who should have known this stuff or should have been talking to them about this stuff, has never brought it up to them. Their banker has never brought it up to them, right? The CPA probably has never brought it up to them. So by educating them, it really builds a lot of trust in you, and it also builds a lot of credibility in you. And those two factors are the two key factors to then develop influence and help people, because now they're looking at you as someone who they really admire, they really look up to, and that they trust, and want to then deploy capital with you. And I think that's a great way of approaching the capital raise, is just educating people and building that trust factor. By doing that over and over and over again, over time, eventually people will raise their hand and want to invest with you. So I think you're doing all the right things, man. Tell me about
Thanks, I learned it all from you, Tim.
I tell me a little bit about the pivot. Obviously, there's a lot of excitement around buying businesses right now. A lot of people raise money for real estate when real estate, over the past, I'd say 2017 to 2022, real estate was the place. Specifically, multifamily real estate was the place to be for raising capital and where everybody was deploying their money. What has happened since then? Interest rates have gone up, insurance costs have gone up, labor costs have gone up, energy costs have gone up, right? And all these things right, pro formas were very ambitious because everybody thought there'd be flat interest rates and they didn't know insurance would jump the way that it has and all these things. And so because of that, right, and the exits were 3 to 5 years out, because of that, a lot of people are finding themselves in a tight spot right now in the multifamily world. Thankfully, we refinanced most of our stuff. I think we have 3 out of 40 different loans, 3 of them that are still bridge, but we don't have anything on variable rates, thankfully. And but we still have to refinance, I think 2 more buildings, 3 more, whatever it is. Anyways, but it's been hairy, right? And it's extended timelines where we're not able to refinance. We're not able to get investors their money back. Sometimes preferred returns in some capacity have either been limited or on hold completely. They're still accruing, right? We'll still catch them up. The beauty of multifamily, though, is that time is always on your side, right? And you still have a fixed hard asset where if you bought it for 10 million bucks, you still sell it for 9 million, even if the economy's or market's a little bit tighter. Or you hold on to it and either let it cash flow or pay down enough principal and let rents increase a little bit. And you hold it longer, but your principal is still safe as long as you don't have to sell. I see some people making bad long-term decisions because of short-term circumstances, right? They're making bad permanent decisions because of temporary toughness. And I think it's a bad idea for a lot of folks. I think they should just have a difficult conversation with their investors of saying, hey, not a right time to sell. I know you want your money back. If we sold, you're going to take a loss. Or we could ride this thing out for another 12, 24, maybe even 36 months. And I think we're going to be in a lot better position. And me personally, I think multifamily is going to start ripping again. There's still multifamily developments that have come online in 2025. But there's nothing in 2026, 2027, 2028, 2029, 2030, because I just read this in an article yesterday, is that builder sentiment, it is at almost an all-time low. It's right around 33% out of a scale of 1 to 100 of how good do you feel about future markets. Builder sentiment is at 33% because they're paying for high interest rates, right? And that's different than multifamily investment sentiment because builders have bridge loans. They're usually building to sell instead of building to rent. Their bridge loans and the construction loans are based on short-term interest rates, not long-term interest rates. And they're trying to predict where the market's going to be in 24 months, 36 months, whenever they deliver their product. And because they're selling, it's hard to plan that because the cost of construction is so high, they don't want to be stuck with it. You can't build a house for less than $300,000 today. You can't build a multifamily unit for less than $175,000, maybe $200,000 per unit now. And it's a very, very difficult place to be for builders. So that means they're not building anything. So the stuff that they were buying in 22 and maybe 23 is being delivered right now. And then there's nothing hitting the market in the future, which means we're stuck with the current housing demand. There's already 4 million housing units short in the US. And we need another 1 million units a year in order to keep up with people moving to the country, people coming of age, being born, right? And I think this is a confusing part for some folks in that, well, there's more inventory coming on the market of people trying to sell houses. That doesn't mean there's more houses altogether. There's a little bit more of people trying to sell, but that doesn't mean there's more inventory. That just means there's more supply of people trying to sell. That's all it means. So what does that mean for us? I think there's going to be, people can't buy a new home. People can't buy an existing home. They can't rent an existing home. So they're going to be looking to rent apartments, townhomes, things like that. So I do think multifamily, from everything that I read, all the conversations I'm having, the mortgage brokers I talk to, the sales brokers I talk to, the CFOs of publicly traded companies that are in real estate, the investment firm, like the people that I know who own billion-dollar funds, debt funds, and equity funds, all believe the second half of this decade is going to crush for multifamily. All that being said, that's my thoughts on multifamily for the next 5 years and what's happened over the past 5, 7 years. From a business standpoint, you've seen the multifamily wane off, and really the businesses start ripping. And I do think businesses are awesome. I have multiple companies myself. I love the trades. I know people, I got good buddies. I have a good friend who just sold his um, trades business for 20 million bucks last week. And it's the most simple business you could possibly think about. And and he crushed it. And I think there's a lot of opportunity for roll-ups. I think there's a lot of opportunity because of these baby boomers retiring and essentially willing to give away or deeply discount the sale or seller finance the sale of these businesses. I'm concerned about it being what multifamily was from 2018 to 2023-ish, right? Or 2017 to 2022. How is their confidence, or like, where's your mindset around, is it a peak? Is it too much of a fad or too many people jumping into it? Why is it still a good investment, right? Because I believe a good business run by good operators is awesome. And I'm wondering if a bunch of bad people, not bad people, bad operators are jumping in, not operating very well. And it does that create the same circumstance that multifamily's in and has been in for the past 12, 18 months. What are your thoughts on that?
It's a good point. I mean, I think you have to have good operators, regardless of what you're going into. So that's kind of a given. The team is going to make you or break you in the long run. The thing I love about the roll-up strategy, because we're raising on with three syndications right now. One of them's a medical dental office, one of them's a paving company, and the other one's a marina roll-up. And the value add, well, there can be multiple value adds. So with marinas, for instance, we're buying mom and pops. Their financials are literally on post-it notes in the office on the marina. Family operation. They've owned it forever. Uh, they're ready to retire, or maybe dad's passed away and mom's needing to unload it. You can pick that up, modernize it, give it some lift, control the expenses, increase your net operating income. But the big bump that I love with the roll-up strategy is you just put a bunch of these together until you have a portfolio large enough that you can sell it to the big check writers, the REITs or whoever it is. That maybe is wanting to drop 50 million or 100 million on a portfolio. They'll pay you a premium because it's already put together and functional. So we're doing a paving roll up. Maybe we're buying these at a 3x multiple, and at the end, we're selling at a 6x multiple. And that second bump on the back end, when you sell to private equity or to a REIT, um, that didn't require any additional capital infusion. So I love that as a value add strategy. Your point's so well taken, though. I mean, you have to make sure that your team is set to run that. So, I mean, I think if you don't have, if the young players in the team don't have the experience in whatever the company is, then you have to have leadership that joins the team, and uh, that provides some level of safety. Back to multifamily, I think you're exactly right. I mean, it's like Rothschild said, time to buy is when there's blood in the streets, even if it's your own. And that's where we are right now. And,
Yeah.
it may get worse before it gets better. But to your point earlier, as long as you can keep belling the water out of the boat and get to the other side of this problem that the Fed's created, it's going to turn around and go the other direction. So, I mean, we're dealing with two issues right now. We're dealing with a government created fiasco, and you can say, well, the Fed's a private company. Okay, whatever. But they are influenced, as you can see.
Mm-hmm.
Trump's influencing them, and things are going to happen there sooner or
Very
later.
much so.
Trump gets his way, right? So at some point in time, the interest rates are going to come down. The problem is there's going to be some carnage with some of these where the notes are coming due and their debt service coverage ratio is upside down, and they can't refinance. And it's a
Yep.
shame to see, that happen, but it just is, and it's going to create some opportunity for people. But to your point earlier, people that don't have to sell, this is definitely not the time to sell right through to the other side because, as you mentioned, with the starts down and the oversupply that we're dealing with, particularly in some of the very popular cities like Austin and Phoenix, it's getting gobbled up pretty quickly. So, a lot of people predicting by 26, we're going to already be on the other side of this, and rents will be appreciating over time, and life will be good again. So,
Yeah.
everything's a cycle.
I think the rent growth is going to be jumping pretty
Yeah. Yeah.
considerably, especially in the market, depending on the market that you're in and how much supply is being delivered to that market. Um, the rents have stayed a little bit flat. I know that they have because, new properties are coming online and older properties can't compete with newer properties. So they got to keep their rents down in order then that's the only way that they can compete with the amenities and offerings and finishes and all that stuff. I, I've found that again, all that stuff's being delivered and there's not anything new really coming online in 26 and beyond. So that means as really we're gonna start feeling the tightening on the demand and what that looks like, I think multifamily is going to be in a really, really good position. So that being said, if you don't have to sell right now, I wouldn't sell, right? I had this conversation with the team. Like we have a huge opportunity ahead. You're familiar with my property management software. And because that's a billion-dollar opportunity for us, multi-billion-dollar opportunity for us, not just that, but kind of the other verticals that we have for that. It's the only reason that I would sell is just to free up time. Otherwise, I would not sell anything. I would just hold it. I'd let it cash flow, let it ride. I do see, to your point, a big opportunity in this rescue capital world of being able to bring some cash, step into a hairy deal right now that can be easily fixed with good operations and a capital infusion. There's a lot of people who never built the muscle on learning how to really raise money. And when you can't raise money, you can't, bail out the boat from the leaks. Then guess what, man? Your only option is to hand this thing back. And that's,
Right.
I think there's a big opportunity to your point on that. And then one other thing I just want to mention is I'm not, I'm not talking poorly about businesses. I just think, I have money in multiple, I don't know, I have LP positions and a fund that goes and invests in these businesses, right? I have $500,000 in my own cash out there in that. And so I'm a believer in it. And I think there's some big upside, right? Like you just mentioned that you can buy these businesses for a 3x multiple, right, of EBITDA, which is essentially a 33% cap rate if you're comparing it to real estate, which is non-existent, right? It's legitimately 5 times the return that you can get from a piece of real estate. So I think mom and pop investors are much more going to get a better return. So even if you had to hold it and cash flow it, you're going to get a great return on that. Realizing there's downside risk, where if you run the business into the ground, it's not backed by a fixed asset where you can kind of salvage it, right? Real estate drops from 10 million to 9 million, you sell it for 9 million, you only lose $1 million. The business you run into the ground could go to 0 million or maybe $1 million, but you lose a much larger amount. And I do agree with what you said on the institutional money, right? The publicly traded companies and the private equity companies are coming in with these bigger checks, and the institutional money is getting better returns in businesses as well because they're able to then go in and buy it even at a 6x multiple. I mean, that's still what is that, 15, whatever it is, 14, 13% return on, no, maybe more than that, 18, 17% return on investment for them. So that's a great ROI for them compared to going and putting institutional money into real estate. Just kind of depends on the appetite, right? Like there's a lot of depreciation benefits on the real estate side, more predictable cash flow, less downside risk. But the businesses balance that out where there's more upside opportunity, there's more cash flow, even though there's a little bit more risk there. And so my point's not to be doing one or the other. It's how can you be involved in both? How can you be involved without being distracted? I think that's a key component of figuring out where is your focus, get the clarity and then the focus. And so how has that been for you? I like that you're staying in your lane. You're like, hey, I'm raising money and then diversifying through both businesses and real estate. Has it been difficult to maintain that focus?
Well, I mean, my focus now is on, researching teams, researching asset classes. We were talking about the market earlier. I mean, the reality is when you start looking at some of these business opportunities, it really goes down to what's happening with a 1 mile radius, because what's happening on one
Yeah.
side of Phoenix may not be happening on the other side of Phoenix.
Yeah.
And in some instances, you may have 2 or 3 properties around you that are giving big concessions, and that forces you to drop your rent. So, right, so it's the micro markets that matter. So I spend a ton of my time right now doing researching teams, properties, deals, trying to figure out where the risks are and what has the most meat on the bone moving forward. And my investors enjoy the fact that we have a fairly wide variety of diverse, uncorrelated asset classes to choose from,
Hmm.
and then within that, they go down different lanes as we talked about earlier. Some of these are solid equity growth plays with little or no cash flow, and others have good cash flow, and some kick out good tax mitigation strategies. So then it just boils down to trying to get the right investor into the right deal so that it satisfies what their needs are moving forward.
What have you, if somebody came to you and they asked, should I raise money? Let's say somebody's in your position where they can raise capital. Should they raise money on a per deal basis or per business basis? Or you have all these opportunities. Do you have anybody knocking on your door saying, hey, package them all together. Let me invest in a fund that then has all these investments and everything's balanced out? What do you think is easier to raise in? And what do you think investors are more looking for?
Yeah, I mean,
It's kind of the same question.
I kind of like the idea of investors being able to pick and choose, what really fits their need, as opposed to just, having a hodgepodge of everything together. There's pros and cons there either way, obviously. But most of the people that I deal with uh, either have a pretty good feel of what lane they want to go down to, or as soon as we explain all of the different options and talk about the cash flow and the equity growth and the depreciation or whatever the tax mitigation strategy is, the light comes on and they have a pretty clear path forward at that point.
Yeah,
Uh, so
I've found similar. It's easier to raise money on a per deal basis.
yeah,
I've also found if they want to diversify, they'll put 100 grand over here and they'll put 100 grand over here. And then they
yeah,
kind of get to make that choice of what they want. And they want, the equity growth, and they want the depreciation. They're okay without the cash flow. And so, hey, instead of investing in a fund or requiring to be in all of them, it again, I think you're trying to solve somebody's problem when you don't need to. I think realizing if you can check all those boxes that we talked about earlier of equity growth, cash flow, depreciation, and talking about principal preservation and all of those, I think that puts you in a good position to have an offering for pretty much whatever anybody's looking for. And then if they want to be involved in multiple, then they bring more money to each of those deals. So I love that. So what does the future look like for you guys? You guys are raising money for these deals. What about 2026, 2027? Kind of what are some of your ambitions or goals and opportunities that you're seeing for Timberview Capital?
yeah. So we're just growing like crazy right now and trying to stay ahead of that. With each growth spurt, it creates new problems that you have to deal with. And we've dealt with a lot of those problems by hiring new people to kind of keep the ball rolling. And, as mentioned earlier, I think there's huge opportunity coming in multifamily in the next few years. So I think right now is a great time to be picking up some of these distressed properties that are coming to the market, and we may not be quite at the bottom yet, but I think we're getting very close.
Mm-hmm.
Between Trump putting the pressure on dropping the interest rate, which I think for sure will happen over the next 6 or 8 months, and then a lot of this excess um, property that's come to the market, particularly in a lot of the popular cities. As the absorption continues and the pendulum swings back the other direction, I think this thing's set to really take off and run like a scalded cat. So I think right now
Yeah,
is the time to get your feet under you because there's no buyers at the table right now. So the deal's
agreed.
fantastic. You just have to make sure that you have a clear business plan and a clear path forward because some of them are so far upside down that you can't really take them at what the loan value is. And I'm hearing frequently that banks are letting them go below that now because they know they
Mm.
have to.
Interesting. Yeah. I mean, this happened in 2008 when I first got involved in investing. I was already in the trades and in the real estate space in 05, 06, 07. As a broker at a painting company. I worked for a big home builder, and I started investing in 2008, 2009. And this was all over the place, man. It was having conversations with the seller's bank saying, hey, I'll come in and buy this thing if you modify the loan and keep it in place, right? Or if you will do a short sale. Like, that was all over the place from 2008 to 2012-ish. Short sales were everywhere. Loan modifications were everywhere. Entire businesses got built during that time of just consulting on these things. And fortunately, I went through that, so I have some level of familiarity with that. And what I have found, because I mean, we've had to extend some loans over the past few years. Had a hairy deal in Texas that we've had to do a loan modification on. They didn't change the principal, but they extended it, and they call that a modification. And they modified what the rate cap was that we had to buy, like just little stuff like that. But otherwise, they got their entire principal back. But what I wish I would have known or had more confidence in is that most of these lenders are very negotiable on that stuff, more negotiable than I think we would think. I think growing up, like, you think about these banks and these institutions, you're like, no, they dictate all the rules. Sometimes they just need things off their books, and you can go in with a proposal. You can go in with an offer and say, hey, if you guys do this, I can do this. And going in, realizing what their pain point is and trying to help them solve their pain point while you getting what you need in order to make this deal done, is a great, noble way to approach that. And I wouldn't be afraid to ask. The worst thing they could say is no. Say, hey, I want to come in. I want to take this thing over. I need you guys to reduce the principal balance by 10% and make sure it doesn't hit the seller's credit. Are you guys okay doing that? Now the seller is good with it because they're getting their hands wiped clean of this thing. They can go free up their time and go focus on other stuff. Maybe their investors lose money, but they're going to deal with that. The bank leaves the loan in place. You get a reduction in principal. You get to step in without bringing any money to the table other than cleaning up maybe some deferred interest or cleaning up, putting some money in escrows, and then taking care of some CapEx at the property. I think it's a play, man. I think we're going to see a lot of that. And I think people need to realize, or buyers need to realize, it's much more flexible than you might otherwise consider.
It gets better with each passing day. So come in and make an offer, even if you're embarrassed to make the offer. Establish the right relationship and stay in contact. We're doing the same thing in businesses. One of the groups that I'm in, we're putting in tons of offers on businesses. Happens all the time. They turn us down. They go with a different offer. Literally 6 months later, they come back. Our last buyer,
tail between the legs. Yep.
Last buyer couldn't come up with the cash. They're back. They're accepting your offer, and here we go. And the banks will do the same thing. They just need, when their pain point gets high enough that they're willing to take a lower offer, they're going to come back to the table and just maintain the relationship and stay in contact.
Yep. And I've seen some of these operators, man. They're willing to sell it at the loan amount. They're taking a bath. Their investors are taking a bath. Hopefully they're making their investors whole somewhere else, but sometimes they're not. But some of these operators are just beat up, right? They're just tired. They're exhausted. They've been getting the shit kicked out of them for the past 2-3 years. And they just want this headache off their plate, man. And so you're seeing it, even if it's not underwater, they're just tired. They don't want to deal with it. There might be other opportunities, or they know that they got to sell this one in order to keep this other one afloat, kind of a thing, and give it the attention that it needs. And I'm seeing it over and over and over again. So there's definitely opportunities out there. If you're not out there swinging the bat, you need to be making those offers. So I love that you guys are doing that, and staying active. I truly believe that's the differentiator. When nobody else is talking about raising money for deals, you guys still are, which means Tyson must know something that these other guys don't. Let me go and talk to Tyson, because he obviously has some things figured out and isn't in as tight of a spot as a lot of these other operators are. And so I trust him. I'm more confident in him. I want to bring money to Timberview. So it's awesome to see, man. I love seeing the growth that you've had over the past couple of years of just like seeing the opportunities and saying, hey, I can go raise a lot of money and utilize that influence that you've built over here in order to then come in and dictate some terms and get involved in some deals and not be constrained by operations. I think that's a really tough thing for a lot of operators where, oh, this isn't just a one-time raise money for 90 days and then be able to go do it again for a different deal. Like, you're in the ultimate leverage scalable position because you work for 90 days on a project, you get paid forever on it or until it exits. These operators, they got to do all the due diligence for those 90 days, and then they have to operate it for the next 5 to 10 years. And so, man, if I didn't have operations built out, I would be doing what you're doing. I think what you're doing is the most scalable way to be involved in business and operation, or in business and real estate.
Yeah, it's like the saying, the deal of a lifetime comes by every week. The question is, do you recognize it and can you take advantage of it?
Mm-hmm.
And, as you know, yesterday's business plan doesn't work today. So, I mean, you
Yeah.
have to be able to pivot and go down a different lane and do something different. But there's a ton of opportunity coming to the market.
Yeah.
So, people are beat up in multifamily. There's a ton of blood in the streets. It's probably going to get worse before it gets better. I heard a discussion recently where some guys that have been in the business for a very long time were reflecting about, what's your biggest regret? And both of them concluded that they would have bought more in the '08, '09, '10
Oh man.
era when all the discounted stuff came to the market. And I think people will be saying the same thing about 2025,
Mm-hmm.
maybe 2026. We don't know when it's going to end, but I think we're getting close to the bottom.
Yeah. Yeah. I think you make a good point. Right. Hindsight's 2020, but markets are cyclical and seasons are seasonality is a very real thing. And you got to maintain that long-term vision. If you always maintain a long-term perspective, you will always make better short-term decisions, what I found.
Exactly.
So
Yep.
good stuff, man. So Tyson, where's the best place for people to connect with you, reach out to you, invest with you? What is it? Can they come and connect with you?
Yeah, timberviewcapital.com, and you can schedule a call with me there. You can sign up for our webinars. We're doing webinars quite frequently, some educational, some deal launch, some deal follow-up. So you can look through the various deals, particularly with the updates, and kind of see how these are changing with time. Um, there's a ton of educational information on the website, and I'm happy to jump on a call. So yeah, just reach out to us, and we're happy to help in any way we can.
Sounds great. Well, I appreciate the conversation. Always appreciate hanging out with you and having, big lifestyle conversations with you and talking about all the trips and travel and all those kinds of things as well. And we'll have to do another one just based on all lifestyle. I want to dive into that next time and when we have a little bit more time together. So appreciate you, brother. Thank you for being here.
Thank you. It's great to be here. Can't wait for your next mastermind. And by the way, Napa was phenomenal. Another
That was fun.
fantastic mastermind. So we're looking forward to your next. Where is your next, by the way?
We're going to be in Asheville at the Biltmore.
Oh, that's right. Yeah, we've already got that on our ticker. So
Yep. Biltmore Estates. So down there in October, and we got a really fun one lined up. It's going to be very similar to like our Jackson Hole, where it's like we're doing a bunch of team building activities and kind of letting loose a little bit earlier after in the afternoon and spending some more time building relationships with everyone. So it's going to be a lot of fun, and appreciate your continued friendship and just always supporting the group and being an active member. So thank you for being here. Make sure you guys connect with Tyson. He's an absolutely amazing business guy, but even better human being. Tons of fun to have conversations with and be around and hang out with. So make sure you connect with him, and we'll see you guys next week on the Legacy Podcast. Thank you for being here.
great to see you, Tim. See you in Nashville.
Hey, well, thank you for being here. Hopefully you got a ton of great value out of this episode. We try to give as much free value as possible across all of our social media platforms. So please make sure that you're connected with us. We are at Legacy Wealth on YouTube. We are at Tim Bratz on all other social media platforms, and we're available anywhere that you listen to podcasts. The best way that you can support this podcast is by just subscribing to our YouTube channel, by liking the video, by commenting on it, and by sharing it with anyone else who might get some great value out of it. So thank you again for being here. We'll see you next Sunday on the Legacy Podcast.